You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name is Trent Fleskens, your host as always. Welcome to the last day of the financial year, and what a financial year it has been in the world and in Perth property. It's one that will be remembered for the start of interest rate drops, for the tariff fiasco, and for the continuation of undersupply of property in Western Australia. With a Labor government back in power, they've clearly got a mandate here to fix that problem. And with the continuation of demand from population growth in our state, it's a problem that's not going to go away anytime soon and needs all hands on deck from a policy, from a cultural, and from an execution point of view across West Australia's property and development industry. So today I thought I would take stock of what this year has looked like, as well as, more importantly, answering, after 3 months of them piling up, a number of questions that have come through over that time from our very smart and funny and loyal listeners who write in all the time. First off, a quick update on where the market's at. We've spent the last 12 months experiencing just under 10% in price growth in terms of median house price. We're sitting at about $780,000 as that median dwelling price now, which has just started to eclipse Melbourne's. We've been hearing about Melbourne's house prices, average prices, and all these things. Different data houses throughout the last 12 months start to be eclipsed by Perth, or it seems unequivocal now, whichever way you look at it, from whichever data house you ask. We have now surpassed Melbourne, which interestingly and not surprisingly has sent most of the East Coast buyers from Perth and back to their home state. Now whether that works out well for them or not, the proof will be in the pudding over the next couple of years as to how Perth's median house price performs against Melbourne's. But one thing we are confident about is that WA is still the peak performer in terms of economic growth, GDP growth, wage growth, low vacancy rates, which is not a great thing to be honest, and therefore house price increases. It'd be a big bet to bet against us at the moment, but that is what's going on from a national perspective right now. What do we expect for the next 12 months? As interest rates start to drop, we expect increases in serviceability and therefore affordability in both people purchasing and paying off mortgages alike, and therefore there's only one way prices can go in that space. We also don't expect that much improvement in our overall capacity to supply new property to the market. Certainly that's the case in the apartment space. It looks like we're going to have less apartments delivered this financial year coming than the one we've just had, which was less than the one we've just had. But we do know that there's a lot sitting in the pipeline, waiting for the numbers to stack up, waiting for price rises to continue to a point where banks will approve them and people will buy them off the plan. In the meantime, the state government could assist, certainly, by removing the foreign buyer surcharge, which makes it that much harder for developers to get their apartment buildings off the ground in the first place, and also having a look at the very broken stamp duty system in this state, let alone this country. So we'll crack onto some questions now, as I spoke about, and hopefully that ties in with a bit of commentary along the way too. First question comes from Gary. Gary says, Trent, we've all seen property values in Perth skyrocket over the last 6 years. I hear it's about 80%. You're about right. It feels like everyone's buzzing around the barbecue again over the last couple of months as interest rates have started to drop. From where you're sitting, what's actually driving the demand? How long do you reckon this boom can realistically keep going for before things chill out a bit? Gary, thanks for the question, mate. How long can this go for and why is it happening? Well, it's happening because we continue to not be able to build enough houses to put a roof over enough people's heads that are coming into this state or that are financial enough to want to buy. That's as simple as that. Until we can solve that problem, of which we don't seem to know when that will be, because it certainly isn't going to be the short term, then prices continue to rise, and that is exacerbated as interest rates drop. So when can we realistically expect the boom to continue until? At least the next couple of years, and then it's anyone's guess as to what the world looks like with regards to our demand side in terms of population growth. But we certainly know that if population growth stays the same, it is people like Mike McGowan, like Tim Reardon, who have confirmed over the last couple of months on this podcast that we won't be able to supply the properties this decade that are required for the population growth we expect to have. So in that space, it is very much a case of the haves and have-nots, and the haves being those in the market and the have-nots being those who can't or choose not to be in the market with regards to owning property, unfortunately. And one thing to note is that we're still relatively affordable compared to places like Sydney and Melbourne, from where we continue to pull people from. Now, I did mention that Perth's properties are more expensive now than Melbourne's. That's not to say they're less affordable. Why? Because we make more money than people in Melbourne. So our properties should be more expensive, or could be more expensive arbitrarily, and they are now because people are demanding property to the extent and we're not supplying enough properties, and we can afford to. So that's how that makes sense. And until we get anywhere near Sydney's prices, you can't actually arbitrarily suggest that we are unaffordable, to be frank. Next question comes from Nikki. Nikki asks, with all the talk about interest rates potentially coming down later in the year, what's your gut feel on how that plays out for Perth? Does it just add more fuel to the fire, or could it actually help more people get into the market and maybe ease the pressure? Well, Nikki, you've sort of answered the question in both places straight away. It does add more fuel to the fire, because as long as there is one piece of demand more than supply in different suburbs and sub-markets in Perth, then if they are able to pay more, they will have to. That's essentially across the board. If everyone becomes more serviceable in terms of their ability to pay more via a larger loan, then that is exactly what is going to happen. So those people who are looking to buy in will therefore just be forced to pay more because everyone can. And then the benefit will be those who have already bought at high interest rates and have budgeted for that, the pressure will actually ease on those people. They will have already seen 10, 20, 30% growth over the last couple of years. And they're now starting to see 10, 20, 30% decrease in their monthly costs on their interest. So it's a bit of a reprieve. Right? For everyone who has had a mortgage, it has been the most expensive time to have a mortgage for a long time, and will have been for quite a few years to come, it seems. So well done for those people who have lasted, and it's starting to be a time for a bit of a reprieve for you. Now, what we know from our conversations with Shane Beaumont a couple of weeks ago, for example, is that we are certainly seeing the pressure come in on increased demand, more people at home opens, more people bidding, but we haven't yet seen massive growth coming out of that. That is going to come through in the data in the next couple of months. I am very confident of that. So right now is that final opportunity to be putting your offers in, getting properties at the prices they are at today, because we are going to continue to see more people do their pre-approvals for larger loan amounts than they were a couple of months ago. And with the expected interest rate drop coming next week out of the RBA, that's going to add more fuel to the fire, increase people's pre-approvals even more, and therefore we start to see that data flow throughout the year. Next question comes from Jacqueline. Jacqueline asks, all right, Trent, spill the beans. Everyone knows about the hot suburbs getting all the headlines, but for us regular folk, what are some of those quieter, under-the-radar suburbs that you genuinely believe have solid potential for decent growth over the next 5 to 10 years? What's their secret sauce? Geez, that's a really pointed question, and speaks to, I guess, niche suburbs that don't get a lot of attention. And the hard thing to really reconcile there is that suburbs that get the most attention get the most growth at the end of the day. You can have best kept secrets, great places where people enjoy their lives, but if it's a best kept secret and no one looks to search for that suburb because it's quite small, then it's not going to have that same demand. It's like a Google search function in a way. The top couple of listings get all of the search results and therefore all the pressure. But let's think about a few suburbs that are smaller, less spoken for in the Perth area. Those would be places like Ascot, Ashfield, Naranda, Highgate, Myrie, Whitegum Valley, Coogee, Belden, Marangaroo, Langford. These are the sort of suburbs that you don't hear being spoken about very often, but that generally offer the same amenity as those suburbs around them. Now, is the amenity in those suburbs changing to make them more attractive suburbs in the way that maybe a Willagee or a Coolbellup have seen improved amenity from improvements from new builds through rezoning and infill, making the suburbs just a nicer place? Not particularly. But are they those smaller suburbs that don't get spoken about a lot, that have a lot to offer? Certainly. Unfortunately, though, the reality is, as I said, it is those standout suburbs that get spoken about a lot that end up getting most of the demand, because people just want to be wherever other people want to be. And those areas, I would suggest, continually, that will continue to be places like your Swanbourne Cottesloes, your Subiacos, your Shenton Parks, your North Beaches, your Triggs, your South Fremantles, Melvilles, Applecrosses, Rossmoyne, Riverton, Shelleys, your Bayswaters, your North Perths, your Mount Lawleys, Inglewood, suburbs that everyone knows where they would be on a map in the first place. They would love to live in the first place as well, and therefore that's where a lot of that pressure goes if possible. At the end of the day, the secret sauce is often just affordability relative to a suburb's peers. So I would be looking at those suburbs that you'd love to be in and see how close the price point is to the one above, the suburb that's arbitrarily better and the suburb that's arbitrarily worse next door to it. And if it's closer to one than the other, you can see where it's going to end up over time. The next question we've got is from Amy. Amy says, if you're a Perth family looking to upgrade, say from a smaller place to something bigger, but you're not swimming in cash, where in Perth do you think you can still find good value? Are there any spots where you can get a bit more bang for your buck without moving to the sticks? Okay, Amy, that's a really personal question. At the end of the day, if you're a family, you really should be looking for a suburb that fits your profile. Are you a water baby? Do you love being on the beach or the river? Do you prefer hiking in the hills? Do you prefer the newer land estates where you've got young kids around so they can all play together? Or do you prefer the leafy green inner suburbs that are actually generally more expensive in the first place? If you're not swimming in cash, where do you think you could still find value in Perth? Value is relative, I guess. It's a perspective thing these days. I would suggest that not many suburbs in Perth, most people would suggest have great value these days. They just are what they are. But if we're talking about a price point, I guess, that's below the median house price, the suburbs where I would suggest you would want to be trying to get into would still be places like Cannington, Morley, Belmont. Those suburbs clearly have a town centre, so they've got all this amenity that you need. You can find properties in those suburbs that are still under the median house price, although getting rarer and smaller and harder maybe for a family. But then you would look at the suburbs just outside of that, your Beachborough, your East Cannington or Ferndale or Queen's Park, or possibly your Redcliffe or Cloverdale. Those are essentially your options there based on how far your dollar can stretch. If you're looking at suburbs that are, let's say, up to $1.5 million, then you've certainly got a lot more options, and I would suggest being as close as possible to those fantastic cafe strips, as close as you can get to Vic Park, so maybe a Lath Lane, Vic Park itself, or East Vic Park. Possibly trying to find a townhouse in Subiaco, or a reno in North Perth or Jundanna, possibly even Inglewood if you can. Those suburbs are ones that have a great walk score. Bedford as well, with opportunities to enjoy your life, not have to move again, not have to upgrade again, whilst interest rates are starting to drop, making it slightly more affordable to have a mortgage in those spaces as well. The closer you can get to water, town centres, great schools in the city, the more likely your property will go up in value over time. Next question we've got is from Dean. Dean says, hey Trent, for those of us who still have a decent sized block and are wondering if we can subdivide, with all the R code changes, especially the Part B, Part C stuff, does it actually make it easier or harder for someone like me to split my block? And what's the biggest mistake people make when trying to do this in Perth? All of the changes with the Part B, Part C stuff that you're talking about, you're referring to the medium density code. The medium density code came out a year and a half ago now, and it essentially made it harder in a lot of ways to do a triplex on a 728 square metre block, which is a sixth of an acre for everyone in the old numbers. Increased setbacks, more requirements for trees. A lot of people will argue for it, but it arbitrarily just makes it harder to do developments at a single story level and pushes people to create townhouse developments, which some would argue is getting with the times, others would argue is simply just pricing people out of the market. That works in North Fremantle and North Perth. It doesn't work in Balga or Girraween. It is making it harder, but at the same time, there are still opportunities for certainly two-lot subdivisions, as well as those triplexes on quarter-acre blocks if you have one left, and congratulations if you do. What are the mistakes people make when trying to do a subdivision for the first time? I'd say underestimating the costs. Most of us are doing that all the time in Perth at the moment, with labour rates going through the roof on anything in the trade space. However, costs like having to reinstall new driveways, new drainage and soak wells, extending sewer and power out to the back block if you're doing a retain and split, underestimating the cost of retaining if you've got slope in the backyard, and the pressures of knocking down trees if you've got them and the council is making it an issue. Those problems are normally the ones that are faced by first-time developers who just did a back of the envelope and didn't understand a lot of those civil costs were going to be a reality. However, the process of doing a subdivision itself from a planning point of view with WAPC is thereabouts the same as it's been for the last 15 years, to be honest. So yeah, the biggest mistake, getting your numbers wrong. Luckily for most people with a growing median house price, any mistakes that are being made are normally being made up for by passive growth in the market too. So it is a good time to make mistakes if you're going to. It was exactly the same outcome for me in 2018 2011 when I was doing my first subdivision in Balga back in the day when prices were growing at about 25% a year. Next question comes from Kira. Kira asks, it feels like it takes ages to build anything in Perth right now, Trent, and costs are through the roof. If I was thinking about subdividing and building a new place, what's your best advice for someone trying to navigate the current builder chaos and make the numbers actually stack up? Kira, that's a tough one to answer, because the reality is prices for new construction, from my observations, have gone up about 80% over the last 6 years now. It is just unfathomable that even 15 years ago you could build a 4x2 with a theatre for $150,000 turnkey. That number is $450,000 now for that same house. I've done the numbers, and that is a 300% increase, obviously. So it really makes it hard for people to see value in building a new home at a single point in time. And it also is hard to trust builders when so many have gone broke. So many are doing work that you might not be entirely happy with, given the shortage of trades out there. And I'm talking more finishing trades. And it takes so long, and therefore your mortgage starts to bite to your savings as well over that time. You should be allowing 18 months. And if it gets done before that 18-month time frame, and a lot are in that 12-month space now for a single detached house, then it's gone pretty well for you. And for a family home, you should be allowing $450,000 at least. For a smaller 3x2 home, certainly somewhere in the mid to high 300s, even up to $400,000 now if it's of any good level of specification. Try and do as much of it as you can by yourself. Use friends for landscaping and painting and things that don't need to be done from day one. But the most important factor of that is to get into the area you can afford first. Now, you mentioned subdividing, splitting your back block off and doing a house behind a house. Now, that is generally more expensive given the civil works, given the driveway length, but you should also be expecting a fairly square house too, so you have a fairly efficient design if you're doing a normal battle axe build. Now, how do we make the numbers stack up? The reality is most house behind a house developments in Perth do not stack up these days. I moved out of that space about 4 years ago, having seen that, and it hasn't really improved. Now, if you factor in passive growth over time, then yeah, it's stacked up, but you may as well have just bought a house for the value of the total development and watch that grow passively in the first place. So there's really not a lot of arguments there for taking the risk of a development if it's just going to be passive growth that makes it worthwhile in the first place. However, there's a lot of skills to be learned in passive growth. There's a lot of benefits to being able to cut your backyard off and maximize your outcome using your equity of the existing house, especially if you want to stay in your own location, upgrade your house without having to move down the street, and then maybe rent out the house at the front. Use that as an Airbnb for maximizing cash flow if you want to. So at the end of the day, there are arguments for it, but I wouldn't be expecting to do a feasibility in getting 20% return out of it in this day and age right now, especially at the simpler end of town. Do your due diligence. Make sure, if you have the opportunity to, get someone to do those feasibility numbers for you so that you're not walking into a project not knowing what you don't know, if that makes sense, because that really is the only way from a risk perspective that you can stuff this up. Everything else will just be done when it gets done, if that makes sense. The next question comes from Perry. Perry asks, seriously, Trent, it feels impossible for first-time buyers in Perth to get a look in right now without a huge deposit or help from their folks. What are some actual clever tricks or lesser-known paths that young people in Perth can explore to finally get their foot in the door beyond just the usual government schemes? Perry, if there are any lesser-known tricks that other people aren't using, I'd like to know them, but these are the ones at least that I would suggest are most likely, and it's a combination of things that include government schemes. First option you've got is, of course, bank and mum and dad. That's the safest guarantee you can get with the least pressure. So guarantor from the bank. The next option is obviously the first home buyer deposit scheme, which requires a 5% deposit, with the federal government backing you in for the other 15%. They don't actually give you the 15%. They just essentially provide a guarantor themselves as if it was a parental guarantee for the other 15% with the bank, so that you don't have to pay lender's mortgage insurance to QBE, which is fantastic. The other way to get in the market, if you're stretching yourself and you're struggling with the affordability side, even with interest rates dropping, is to be a rent investor, is to essentially rent out the property that you want to buy in first. You can therefore include proposed rent into your income calculations in your application, which will help you get a higher loan than the banks would have otherwise allowed you to. Now, you can have that tenant in for 6 months, for a year, whatever it is, and then you can kick them out, move in. As long as you're still paying that mortgage, you can tell the bank that, hey, I'm an owner-occupied now, I want an owner-occupied interest rate, and they're not going to kick you out. In that time, you would have seen, hopefully, some passive growth in the capital space as well, and as long as you're paying that mortgage, you'll be hunky-dory. So that is a way that a few people do stretch to get themselves in the market, and I guess it's a lesser known way to do it. Regardless, if you're doing the rent vesting space, you're obviously still going to need about a 13% deposit, because the first home buyer guarantee scheme doesn't apply to investors, obviously. So you'll need 10% deposit plus a bit more for allowing your lender's mortgage insurance to fall into the loan as well. So we normally say about 13%. You'll also need to pay for stamp duty too, given most properties that you'd want to buy these days are well above the stamp duty threshold. Thanks a lot for that, treasurer. Last idea would be to go in with a friend. If you look at places like Sydney, for example, a far smaller percentage of people are buying by themselves because it just doesn't add up. They make less income than us, and the median house price of theirs is double what ours is. So if a Perth person is struggling, what do you think a Sydney person is doing at the moment? What they're doing is they're going in halves with their mate, their sister, their partner, or even their parents as well. If you really want to get into a much nicer area than you could afford by yourself, the way that it's been done on the East Coast is getting a couple of people together and making it happen. Next question comes from Gerald. Gerald says the WA First Homeowner Grant is only for new homes. That's correct. Does that mean it's smarter for first timers in Perth to focus on house and land packages, or should we stick to established homes and suck it up without the grant? What's the trade-off? Gerald, I find that the market essentially absorbs the first homeowner grant. It goes to the builder. They factor it into your house and land package cost. It essentially goes to them. It flows through to them at the end of the day. So buying a house and land package, whilst helping with the supply in this market, is not arbitrarily a better idea. In my opinion, and it always has been, buying in established areas as close to the city and or the river as possible has done me wonders. Now, certainly you could buy established properties out in the house and land suburbs too, and they've done really well based on affordability and the increase in the cost to build a home next door in those areas. That has sent the established house price of places like Ellenbrook from about 400 to about 800, so nearly double. So certainly their amenity hasn't changed, but it's been that replacement cost theory outcome that has increased the price of those properties too. I would focus on the largest home you can find that was built about 10 years ago for what would have been about half the price of what it could be today, because that price increase probably still hasn't been factored in totally to the price of that established home in the first place. That would be my goal. And then you just pick the suburb. So largest house with the largest block in the best area possible. Don't worry about the first homeowners grant. And it sounds like you're going to be above the stamp duty threshold anyway. Next question comes from Jesse. Jesse asks, Trent, getting a loan feels like rocket science these days, especially with the Perth prices the way they are. What are the sneaky things that can really mess with your borrowing power that most of us don't think about, and what should we do before talking to a broker? Great question. What are the things that stuff you around when you're doing an application for a loan? It's essentially your other loans. If you've got debt on credit cards, on store cards, on cars, on personal loans, anything that isn't a house loan, and if you're looking to maximize your serviceability of that proposed house loan, then it needs to go, essentially. Now, there is an opportunity to refinance all that existing debt into that new loan if the bank allows it, and if you've got enough of a deposit to cover the loan-to-value ratio in the first place. That would help, especially given the fact that most other loans are higher interest rates than the home loan you'll be going for. But we can also focus on things like income type. Most banks don't like casual work. No bank will give you a loan if you don't have 6 months of casual work, and only a couple of banks will. A lot of banks don't like contract work. They will discount income that is overtime or site penalties. So these are the things that if you can try and get a permanent full-time job with a salary and at least a couple of years of demonstrated consistency on things like bonuses and overtime, it will do wonders to help your broker give you the highest serviceability in the first place. At the end of the day, the more savings you have or have access to via a guarantee, and the cleaner income you've got and the less expenses you've got to put on your application form, the high serviceability you will get. Outside of that, at the end of the day, getting a loan is about as easy as it's ever been in terms of the process, as long as you're as clean as possible, an applicant with regards to your credit score and credit history for a bank to assess. Next question, and I think the final question, comes from Namita. Namita asks, beyond just fixing your interest rate or going variable, what are the most common financial blunders Perth homeowners can make with their mortgage that ends up costing them a fortune over a lifetime? Are there any strategies that are particularly good for Perth property owners right now? At the end of the day, your home loan is your cheapest interest rate you are ever going to get. We're looking at interest in the 5% right now. We'll probably be down to 5%, if not 4 point something percent within the next 12 months. That is cheap debt. Now, globally, it's not that cheap. Places like Japan and Switzerland have interest rates that are half that. But for our market and our history and the alternative forms of debt, it's as cheap as it can get. A lot of people have been told by their parents, pay your loan off, get rid of it as soon as possible. I would advise that can be good advice, but only if you've got nothing better to do with that money as well. If you have other things you can invest in that will make you more than your interest rate with your home, then it would also possibly make sense for you to invest in that money rather than just paying your home loan off. How can you really stuff up? By not forecasting to have enough cash flow to pay your mortgage in the first place, letting that compound and increase and then getting into default territory where you've got a black mark against your name. That's bad because that doesn't go away for a very long time. So make sure that when you are budgeting, you understand exactly what your household budget is, what your risks are in terms of maybe cash isn't going to come in at this time, and also what your future earnings might look like, up or down. Cater for that. And as long as you're confident that you can pay that mortgage, a variable rate most of the time over most of history has been the best outcome for consumers because fixed rates are essentially a contract agreement with a bank that has more information about the markets than you. COVID was the first time I saw it in my lifetime where a fixed rate actually worked out for most of the population. I don't see the banks being silly enough to have to make that opportunity come to light again. The best thing you can do with your mortgage is pay off what you have to, and if you've got nothing better to do with your money outside of the money you spend on your mortgage, feel free to put that in your offset account or your redraw account so that your interest payments are zero and all you're doing is paying off your principal over time. Rainy day money is always important when it comes to families' budget, and it allows you to be flexible, which is why a redraw account and an offset account is valuable. I just wouldn't look at it as your best form of investment going forward. Guys, that's the end of this financial year. Thanks a lot for listening to all of the 52 episodes we had over this last financial year. I'm really excited to see what FY26 looks like. It'll certainly include price growth in Perth again. It'll certainly include sustained undersupply of property in Perth again, and hopefully it will include some great guests on this podcast going forward. Have a great end of financial year celebration. See you in the new year.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!